Most people believe a lie about their 401k. They think the government has drawn a hard line in the sand, telling them they can only save around $23,000 a year. You hit that limit, you feel good, you stop. But there is a second, much higher line that almost nobody talks about. The real limit isn't $23,000. It is closer to $69,000. That is a $46,000 gap. If you are a high earner and you are stopping at the first limit, you are effectively lighting potential tax-free wealth on fire. Today, we are going to talk about the Mega-Backdoor Roth. This isn't some shady offshore scheme. It is buried right there in the IRS tax code, specifically Section 415C. It is the single most powerful tool for stuffing massive amounts of money into a tax-free account. Yet 90% of people who are eligible for it do not even know it exists. Before we get into the mechanics, I need to clarify something. This is not the standard backdoor Roth IRA that you might have heard of, where you shuffle $6,000 or $7,000 through a traditional IRA. That is child's play compared to this. The Mega-Backdoor is an entirely different beast that lives inside your 401k. It allows you to contribute tens of thousands of extra dollars every single year, and then legally convert that money into Roth assets. If you do this right, you never pay taxes on that growth again. If you do it wrong, or if your plan doesn't support it, you can end up with a tax headache. So we are going to walk through the math, the specific plan requirements, and the exact sequence of buttons you need to click. I treat these videos like a briefing for a friend. I am not a financial advisor, just a guy who reads the fine print so you don't have to. If you are looking for a way to optimize your high income, this next 30 minutes will likely offer the highest return on investment of any video you watch this year. The difference between a standard retirement account and a mega backdoor strategy can effectively be millions of dollars over a few decades. If that sounds worth your time, do me a favor and subscribe to the channel so we can keep running these numbers together. Now, let's look at the invisible ceiling that is holding your savings back. Let's start with the myth. You walk into your HR office or you log into your benefits portal and you see a warning. It says the IRS limit for employee deferrals is roughly $23,500 for 2025. You set your contribution percentage to hit that number, the system congratulates you, and you think you have won the game. You haven't. You have only filled up one specific bucket. That $23,000 limit only applies to your pre-tax or standard Roth salary deferrals. It does not apply to the total amount of money that can enter the 401k plan. The IRS actually allows a total annual addition of $69,000, or even more if you are over 50. That is the real number. The gap between what you put in and what the IRS allows is vast, and that empty space is where the mega backdoor strategy lives. Let's put hard numbers on this so you can see the opportunity cost. We will use the 2024 limit of $69,000 just to keep the math clean, though 2025 and 2026 are higher. Imagine you earn enough to max out your regular deferral. You put in $23,000. Your employer is generous and gives you a match of $10,000. So 23 plus 10 equals $33,000 total in the account. Most people stop there, but the IRS limit is $69,000. If you subtract your $33,000 from the $69,000 limit, you are left with $36,000 of empty capacity. That is $36,000 of tax advantage space you are leaving on the table every single year. Over 10 years, that is $360,000 of principal alone that could have been growing tax-free, but instead is likely sitting in a taxable brokerage account, creating a tax drag every time you get a dividend. You might be wondering, if this space exists, why doesn't the 401k portal scream at me to fill it? Why doesn't HR send an email about it? The answer is complexity and compliance. Most companies design their plans for the average employee who is struggling to save 5%. Explaining Section 415C after-tax non-Roth limits confuses people. Furthermore, plans have to pass non-discrimination testing. If only the highly compensated employees use this feature, the plan can fail IRS tests, which causes headaches for the company. So, they often enable the feature but don't advertise it. It is a velvet rope. They aren't hiding it maliciously, but they certainly aren't rolling out the red carpet. You have to be the one to calculate that gap yourself. You have to be the one to proactively push money into that space. Here is the protocol for this section. Stop looking at the $23,000 limit as the finish line. Start viewing it as a milestone. Go look at your pay stub or your 401k dashboard right now. Find the total amount you contributed and the total amount your employer contributed. Add them up. Then, look up the current year's Section 415 annual additions limit. Subtract your total from that limit. The number you see on your calculator is your potential mega-backdoor capacity. For many of you listening, that number is going to be $20,000, $30,000, or even $40,000. That is the target we are going to try to hit. But to hit it, we need a specific mechanism, because you can't just throw money in there any way you want. Now, before you rush off to dump your savings into your 401k, you need to stop. If you just shove after-tax money into your plan and leave it there, you are actually making a mistake. You might even be worse off than if you had just used a normal brokerage account. Why? Because after-tax contributions that sit inside a 401k grow tax-deferred. But when you pull the earnings out, they are taxed as ordinary income, which is the highest tax rate you pay. We don't want high taxes, we want zero taxes. The magic isn't the contribution, the magic is the conversion. If you miss the conversion step, you have trapped your money in a high-tax environment. To understand the mega-backdoor, you have to visualize your 401k not as one account, but as 3 separate buckets. Bucket 1 is pre-tax. That's your standard deduction. Bucket 2 is Roth. That's your post-tax salary deferral. Bucket 3 is the after-tax bucket. This is the confusing one. It is not Roth. It is money you put in after you have paid taxes on it. But it doesn't get the special Roth tax-free treatment automatically. It's just sitting there. The mega-backdoor strategy is a 2-step dance. Step 1, you fill up bucket 3 with that extra $30,000 or $40,000 we calculated. Step 2, you immediately open a trapdoor and drop that money from bucket 3 into bucket 2, the Roth bucket. Once it lands in the Roth bucket, it is shielded forever. Let's run the formula again to be crystal clear, using the 2025 numbers. The total limit is $70,000. The employee deferral limit is $23,500. Let's assume a $7,000 employer match. The math is 70,000 minus 23,500 minus 7,000. That leaves $39,500. That is your after-tax contribution limit. You instruct your payroll to deduct this amount from your paycheck into the after-tax source. Then, and this is critical, you execute an in-plan Roth conversion. You tell the plan administrator to take that $39,500 and recharacterize it as Roth. Since you already paid taxes on the money before it went in, you owe 0 taxes on the conversion amount itself. You have just moved nearly $40,000 into a Roth account through the back door, legally bypassing the income limits that usually stop high earners from contributing to Roths. The psychology here is interesting because the terminology scares people off. When you hear after-tax contribution, your brain hears taxable brokerage account. And you think, I can do that at Vanguard myself. Why lock it up in a 401k? That is the trap. In a brokerage account, you pay capital gains tax every year on dividends and eventually on growth. In this strategy, once that conversion happens, the growth is tax-free. We are talking about 30 years of compounding with zero tax liability at the end. The barrier isn't the math, the barrier is the jargon. People are terrified of making a mistake with the IRS, so they stick to the simple path. But the wealthy know that complexity is often where the alpha is hidden. Here is the execution protocol. It is called fill and flip. You cannot just make the contribution and forget it. You must automate the flip. Check if your plan offers automated in-plan Roth conversion. This is the holy grail. If you check this box, every time your paycheck deducts the after-tax money, the system automatically converts it to Roth the same day or the next day. This means there is no time for the money to grow while it is in the after-tax bucket, which means there are zero taxes to pay on the transfer. If your plan requires you to call them to move the money, you need to set a calendar reminder to do it every month. The longer you wait, the more taxable earnings accumulate. Automate the flip if you can. Now, a warning. This strategy fails catastrophically if your plan only has half the features. I call this the zombie money trap. Imagine you pump $40,000 into the after-tax bucket, and then you call your provider to convert it, and they say, "Oh, sorry, our plan document doesn't allow in-service withdrawals or in-plan conversions." Now you are stuck. That money is trapped in the after-tax bucket until you quit your job or retire. It will grow, but the earnings will be taxed as ordinary income, which is worse than if you had just invested in a standard index fund in a brokerage account. You must verify eligibility before you transfer a single cent. Most people assume their plan doesn't offer this because they don't see a big Mega-Backdoor button on the dashboard. But plan documents are dense. You need to look for two specific phrases in your Summary Plan Description, or SPD. First, look for after-tax employee contributions. Again, this is distinct from Roth. Second, look for either in-plan Roth conversion or in-service withdrawal of after-tax funds. You need both. If you have the first but not the second, you are in the zombie money trap we just talked about. If you have the second but not the first, you have nothing to convert. It is rare to find a plan that advertises this clearly. You often have to dig into the PDF documents or get a representative on the phone. According to data from groups like Vanguard and Fidelity, about 40 to 50% of large plans now offer these features, and the number is growing. Tech companies are notorious for offering this. Amazon, Google, Microsoft, they all generally support the Mega-Backdoor because their engineers demand it. But even older, legacy companies are adding it. The key metric to look for is separate accounting. Modern record keepers track your pre-tax, your Roth, and your after-tax money in separate sub-accounts. This is crucial. If the accounting is commingled, the IRS pro rata rule kicks in, and you can't cleanly convert just the after-tax portion without triggering taxes on your pre-tax money. You need a plan that can isolate the after-tax basis. If your provider is a major player like Fidelity or Schwab, the infrastructure is likely there. If it's a small local provider, you need to be much more careful. There is a social barrier here too. Nobody wants to be the person calling HR, asking complicated tax questions. You feel like you are being annoying or greedy. But remember, the HR representative is not a tax expert. They often don't know how their own plan works at this level of granularity. When you call, don't ask, "Can I do a Mega-Backdoor Roth?" They might not know that slang term. Ask specific, Technical questions. Does our plan allow non-Roth after-tax contributions? And does our plan allow in-plan Roth rollovers of those specific contributions? If they hesitate, ask for the summary plan description document so you can read it yourself. You have to be your own advocate here. No one is going to hand you this tax break. If you find out your plan does not support this, don't just give up. The protocol changes from execution to lobbying. Highly compensated employees have leverage. If enough senior staff ask for a feature, the benefits committee listens. I have seen people draft a simple email to their benefits coordinator saying, "I noticed our peer companies offer after-tax contributions with in-plan conversions. This is a major retention tool for senior talent. Can we explore adding this to our plan amendment next year?" It costs the company very little to add these features with most modern providers. You might be the reason the entire company gets access to this strategy next year. It is worth sending the email. Before we move to the final execution strategy, we have to address the elephant in the room: Congress. They know about this. In fact, there have been multiple bills proposed to kill the Mega-Backdoor Roth. They almost succeeded a couple of years ago. Why am I telling you this? Because this loophole might not be open forever. That isn't a reason to avoid it, it is a reason to hurry. If they change the law, they usually grandfather in the money that is already in the Roth accounts. They just stop you from adding more. So every year you wait is a year of capacity you can never get back. This is a use it or lose it opportunity. Let's talk about the practical reality of doing this. It is expensive. We're talking about diverting huge chunks of your paycheck. If you are aiming to fill a $35,000 gap, that is nearly $3,000 a month coming out of your net pay. This is after-tax money, so it reduces your take-home pay dollar for dollar. You need to have your cash flow dialed in. This strategy is for people who have already maxed their pre-tax 401k, maxed their HSA, maxed their regular backdoor Roth IRA, and still have surplus cash. Do not do this if you are carrying credit card debt. Do not do this if you don't have an emergency fund. This is a level up move, not a foundational one. But if you can afford the cash flow hit, the math is staggering. Let's compare two scenarios. Scenario A. You put $30,000 a year into a taxable brokerage account for 20 years, earning 7%. You pay taxes on the dividends every year, and then 15 or 20% capital gains tax at the end. Scenario B. You put that same $30,000 into a Mega-Backdoor Roth. Same growth, but zero taxes on the dividends and zero taxes at the end. Over 20 or 30 years, the difference isn't just a few grand. It can be hundreds of thousands of dollars in saved taxes. You are effectively increasing your investment return by your tax rate. If you are in a high tax bracket, say 37% federal plus state, shielding that growth is the equivalent of earning a massive guaranteed return on your money relative to a taxable account. The hardest part of this strategy is the seed versus harvest mentality. When you contribute to a pre-tax 401k, you get a tax break today. It feels good. You have more cash in your pocket now. With the Mega-Backdoor, you get no tax break today. You pay full taxes on your income and then lock it away. It feels like a sacrifice. You are planting seeds that you won't harvest for decades. But you have to realize that tax rates today are historically low. If tax rates double in 20 years, the person with the massive Roth account is a genius. The person with the massive pre-tax 401k is a victim. You are hedging your bet against future government spending. You are paying the toll now so you can drive on the freeway for free for the rest of your life. So, how does this end? What happens when you leave your job? This is the best part. When you separate from service, you can roll your Roth 401k balance directly into a Roth IRA. Once it is in your Roth IRA, it is subject to Roth IRA rules. That means no required minimum distributions, RMDs. You can let that money compound until you are 90 or pass it to your heirs tax-free. If you had left the money in a pre-tax account, the government would force you to start withdrawing it and paying taxes in your 70s. By using the Mega-Backdoor, you aren't just saving taxes, you are buying control. You decide when to take the income, not the IRS. That flexibility is priceless. Let's bring this all back to a simple checklist. First, ignore the $23,000 limit. Look at the $69,000 limit. Calculate your gap. Second, check your plan documents for after-tax contributions and in-plan Roth conversions. You need both. Third, automate the contributions and, crucially, automate the conversion to avoid tax drag on the earnings. And fourth, ensure you have the cash flow to sustain this, because you are paying taxes up front. It is a heavy lift. It requires paperwork, phone calls, and cash flow discipline. But it is the only way to get 5 or 6 times the normal annual limit into a tax-free wrapper. It is the ultimate force multiplier for high earners. I want to hear from you in the comments, especially if you have actually tried to set this up. Did your employer allow it? Did HR look at you like you were speaking Latin? Drop your experience below. It helps the community figure out which providers, Fidelity, Empower, Vanguard, are making this easy and which ones are making it hard. We are crowdsourcing this data because the official guides are often outdated. If you found value in this deep dive, hitting the like button helps the algorithm show this to other people who are probably underutilizing their 401k right now. Thanks for watching, and I will see you in the next one.